Well, taxes are something a lot of us don't like to talk about or even think about, but you kind of have to. But this is why we like to, from time to time, bring in our investment guru, the president of Heritage Capital LLC, Paul Schatz. And this is rapid fire. You want tips? You're about to get a lot of tips. Good to see you again, sir. Okay, let's get right to it. A lot of different things, a lot of different bits of advice you have for people. So we put them up on some screens. I want to get them up there while you're talking about it a little bit. But what should we start with? How about doing a dry run of the tax return?
I just did my perfect time of the year to have your accountant or yourself through TurboTax do a quick run through of your taxes. Make sure you don't have a huge tax bill, nor do you want a huge tax refund at this time.
Okay, harvest your capital losses. What do we mean by that?
So this has been a great year in the markets, one of the best years of this century. However, if you have positions with losses, let's say you lost money in Delta.
Yeah.
My recommendation would be to sell Delta, go buy American Airlines. Sell JetBlue, go buy Southwest, so you can take the loss on your taxes in 2019.
But still keep it within the same industry, it sounds
exactly, right, because the stocks will move, not the same, but similarly.
Okay, yeah, that makes sense. Recognize your capital losses up to $3,000.
The IRS allows you to write off $3,000 of capital losses a year. At the end of the year, you take all your gains, you subtract all your losses. Anything more than $3,000, you have to carry forward to another tax year. So make sure if you harvest your losses, you have some gains to offset them. Make sure you can write off $3,000 of losses.
Now, when it says beware of mutual fund distributions, why?
Unless you have a 401k or an IRA, this time of year, mutual funds, by IRS law, reg, they must send out what's called capital distributions. Fancy word for they're going to send you money but give you an immediate tax bill. So be very careful putting new money into mutual funds that haven't already distributed capital gains. It's all public. You can look on their website and they'll tell you.
You got it. Max out your 401k. That's one of the more obvious ones for us financially illiterate
I mean,
people.
that's the easiest one of all. Those fortunate enough who can put away $19,000 a year or an additional $6,000 if you're old like I am, over 50. Please do that. You can take your last paycheck or two, put it all into your 401k if you can financially swing that.
Take your RMD. What's that?
Required minimum distribution.
Got it.
Those are for folks with IRAs or 401ks who have turned 70 and a half. If you do not do that, the IRS will penalize you 50%.
And you see, donate the RMD to charity. Get that in a second. Well, just one other bullet point on the other graphic we had. Defer your bonus.
If your company's going to give you a year-end bonus, I would always go to your boss and say, "Hey, could you give me my bonus in January, not December?" Because if you get paid in January, that tax isn't due until April of 2021.
So you have some time to.
Much better off deferring income till 2020.
Capitalize it. Okay, back to the RMD. Donate it to charity.
Much easier if you have an RMD. Required minimum distribution. You can donate it to charity and not take it, which first of all simplifies your life because you don't have to take the income and then donate it, and it's also much better for your tax situation.
Okay, but you got to spread things out when you do donate to charity.
With the 2018 tax reform package that was passed by Congress, signed by the president, each family now, each couple can write off the first $24,000 standard deduction. So 75% of the country is doing a very short form of the taxes. It makes giving to charity harder because most people can't write it off. So what I'm saying is every other year, lump your charitable contributions. So you can possibly write them off.
There you go. That makes more sense. Yeah, if you just lump them together. All right, donating your appreciated stock. Is that part of it too?
That's an easy one. So think about this. You owned Apple this year or you own Google this year. They've had meteoric rises. And let's say you wanted to raise some cash or perhaps take some off the table. Instead of doing that, donate some of that stock to a charity. You don't owe tax on it, and you don't have to give a charity cash out of your pocket end of the year.
And then your FSA, that's money if you don't spend it, you lose it, right?
Use it or lose it. IRS, $2,700 max. It's a fringe benefit by your corporation. Do not forget to spend that down.
The 529, another thing, it would be wise.
If you have kids that you're hoping to go to college, some states will allow you to deduct part of that 529. It's like an IRA for kids going to college. If you can afford to swing it, put some in your kids' 529 plan.
Yeah, you can set up an automatic deduction. That's what I'm doing for my boys. Yeah, easily. Lastly, gift up to $15,000.
Every individual in the country, the IRS lets you gift $15,000 to anybody you want. So next week, You and your wife can write me checks for $15,000. That just brings the value of your estate down and legally able to give somebody else money.
I like to say certain segments have information density. How much information can we cram into 4 minutes? He's the master. Paul Schatz, Heritage Capital.
Happy holidays,
Good to see you. A pleasure. All right. What do we got to get to next? We have a lot going on. We want to talk about the forecast, too. Matt Scott is standing by with that. We also have breaking news in New Haven. Tony Terzi is covering reports of a shooting. So let's get out to